Boom, we are live, ladies and gentlemen. Thanks for joining us today. We're going to be taking a look at Bitcoin's price on the daily chart and why I believe we've broken down into some sort of a distributional pattern. It may not be the end of the bull market, but it sure isn't looking great. So to start, let's look all the way back here at the beginning of this bull market in early 2023 when we started to move above the 300 and the 200 and 314 day simple moving averages, which are these green lines here. As soon as we broke above, we tested it, and then we continued to test it multiple times throughout this market cycle. Now, where we are today, which is everyone is more interested in, this is the first time we've broken down completely below the simple moving averages on the bear claw. So what does that mean? Now, we're taking a look today at the Wyckoff distribution ranges. Now, the trading ranges are equally as important, but less important. Are important, but less important. Excuse the mistake there. But less important than the volume signatures. What we're looking at for volume signatures is called reaction and result. So it's the amount of supply that comes into the market and the price spread that happens between each of those movements. Now, we seem to have formed our primary support at around the $100,000 range. We had our first buying climax, our automatic reaction to the downside, an upthrust, and then distribution, pushing into a sign of weakness, which broke all the way down to the primary support. Now we've seeing a last point of support, which is the LPSY. When we could not return into the top of the trading range, hit around 107,000, and we've returned completely back downwards. Now, I do suspect we're going to see another rally, probably upwards of 103,000, but it's likely that that is as high as we will go. We'll see some sort of final reaction that looks like this, that takes us from where we are approximately now into the $103,000 range like this, and then all the way back down to around 80,000. Now, this could end up, there's a few things that could happen here. We could find out that this is part of a much larger trading range, or we could actually end up coming all the way back to around 110, 111,000, and then making what would be a total head and shoulders, which would be a total reset of this market cycle, which could still be the case. That this market cycle is completely over, done, dusted, and finished. So let's focus on the volume signatures for just a minute, because I believe that's really crucial. Most people just look at the trading ranges. The Wyckoff guys posted something really funny the other day. They said a Wyckoff trading range without volume or supply signatures is like a selfie without the face in the photo. That's not how it works. You need to know what's going on with the supply and demand characteristics to understand the Wyckoff trading ranges and its methodology. So let's focus on that for a second. What we ended up getting, this huge amount of supply that came into the market right near the buying climax. These were probably two key indicators that I missed. I was not totally with it. Two huge amounts of supply coming in right near the top of the market, likely indicating that we're going to test. Now, we came to the downside on less supply than it took to go to the upside. So again, what we're looking for here is how much price spread is there to the amount of supply coming into the market. So here, again, another key indicator was the amount of supply that came in to push us up, and then the amount of supply that came in and how far we got pushed down. So there was a lot more supply entering the market to the downside after the buying climax, which is what we had seen previously. This LPSY, this move up to around 107,000, and the inability to get back inside of the box was probably the strongest indicator that this was a sign of weakness. Now, in the bear den, I got to admit, I was wrong. I wasn't paying super close attention to what was going on. I was busy with other things. I wish much more deeply that I had been paying attention to what was going on, because these are big moves to the downside. But I had actually initially labeled this as a potential spring. I was wrong. This was not a spring. It ended up being a sign of weakness in the asset itself. Now, I was maybe it was just my hopeful self, but nonetheless, part of that was it would have been more noticeable if I'd been paying attention to the volume and supply signature. So we make mistakes. Hopefully, we learn. And right now it looks like we're going to be headed much lower for Bitcoin. But I suspect we're going to try to push into the 102, 103, maybe back even as high as 111. Sometimes we see these secondary pushes come all the way back into the middle of the trading range, and this end up being an LPSY, the sign of weakness, and pushes our LPSY to something like this. So if we scroll over to our diagram here, obviously these are idealized versions of what an upthrust in phase C and then a phase E breakdown looks like. Again, here the LPSY does not return to the top of the box, but we see 2 tests at the bottom of the range. Here we've had 1 test at the bottom of the range. Again, perhaps we get a second one. If not, I suspect to around 102, we probably get a quick bounce and then a big turnaround. What does that look like on the weekly? I think here with the bear claw, again, we see some pretty valuable data. Yeah, we have not retested the 200 or 314 simple day moving average basically at all. I suspect we're headed to at least 88,000, which is where the exponential moving average bands are for this particular range. But again, if we get rid of the bear claw to clean up the data here, it looks like this. It's much clearer, I think, on the daily, but it looks like this was distribution. Now, you might be saying, well, Tio, could this be just a temporary distribution and then we come back up even higher? Yeah, I suspect that's the case. Again, as an example here, in the previous upcycle movement we had, the distribution was temporary and it turned into a local reaccumulation not long afterwards. So this was important to recognize, is that we do have accumulation followed by, distribution followed by accumulation quite often. So I'll label these green and red for the respective ideals that are happening here. But here we saw a distributional range turn into a breakdown, a reaccumulation, and then a breakup. Now, this looks like a much larger distributional range. We see we actually see decreased supply signature coming in, which is quite interesting. This leaves me a little bit confused. We had significantly higher supply signatures coming in. But again, the point here is that we're actually seeing bigger reactions to the downside for less supply coming into the market. So this entire reaction to the downside versus this reaction to the downside here, and the amount of volume, or the amount of supply or volume, however you like to name it there, coming in was significantly lower. Look at the price difference between the spread difference between these two. Here's the spread of the supply, significantly less supply coming in, but equal, if not more dramatic movements to the downside. These are usually signals, again, that we're near the end, or at this case in point, maybe this is the end of this particular cycle. So on the daily with the bear claw, we do see something, again, I think that is quite useful to recognize, is that we have not in any way, shape, or form broken down below these 314 simple day moving averages for quite some time. The last market cycle, when we did break below it, we tried to come back up and test it once before breaking down completely and going into a full bear market. So I do suspect that that's what will be the case here. We actually try to get a larger upcycle movement, probably from around here to where we are, to get back between probably 102, 103 to maybe even as high as 111. If we cannot reclaim those areas, I'll move the LPSY to over here, and then we break down to 80,000 and could come even lower. Again, on the weekly, we do not have any support for the bear claw basically back until $50,000. So we're going to keep a close eye on this. Could we get another reaccumulation box similar to what we had just a few months ago, where distribution turned into reaccumulation like this one, and then we ended up going higher? Could we be sitting in a distributional range that in the very near future turns into a reaccumulation range here? Let's mark this one potentially green. Yes, that is a potential, but for now, as long as we stay below the previous trading range and cannot get back above the simple moving averages at around 111,000, this is going to become a redistributional range as well. So whether it's red or whether it's green has still yet to be seen, but this was definitely a distributional range. So could we be moving into a reaccumulation range of some kind? I think that that's possible, but I don't want to bet on it right now for right now, it looks like we could be coming quite a bit lower, somewhere between the $50,000 and the $80,000 range. Well, we're going to try to step by step with you. Now that we're back full time with the Bear family, I've got this house here for the next 7 days. Got a new place we're going to for 7 more days where I'll be able to set everything up. And like I said, in the meantime, I'll be able to use the small camera, even if it means I can't use my fucking fancy mic camera and my ability to zoom in and switch screens like I'm a champion and high on fucking buttons or something. So anyways, I wanted to let everyone know I'm going to drastically reduce the limit of time that you can sign up under the 60% discount. So you have 72 hours max from yesterday. So there's only 48 hours left now to use the code hard reset, which will get you a 60% discount. Now, some of you are a little confused. There is no lifetime membership, but if you want to use it on the daily, the monthly, I was thinking about charts here. If you want to use it on the monthly membership, it will work there, as well as the biannual or the annual memberships. So for those of you that were confused, it's not just for the lifetime membership. The 60% off for the next 48 hours works on all the memberships. So if you've ever received value from me and you would like to support the rebuilding of the Arcane Bear channel as I come back, go ahead and sign up. Because remember, the disease of the average investor comes from overtrading and the lack of emotional fortitude to make it through the long winter nights, to buy right and sit tight. So join a group of private investors that know what they're doing. And if you guys aren't happy, remember there's a 30-day money back, no questions asked guarantee. So sign up, try it out. If you're not happy, well, let's give your money back. It's fine. It's T with the Arcane Bear. Thank you guys all for the support in the video yesterday. Hopefully this has been helpful. If you are new to Wyckoff method, all of our educational pieces come packed full on how to use the Wyckoff accumulation and reaccumulation, but it does sadly look like we are in the distributional ranges instead of the beautiful reaccumulation ranges. T with the Arcane Bear, we're signing off for the rest of the day. We'll see you guys again on the next episode.